And I just think, as I said earlier, the run to gold has begun and that the run will continue. As I said on another interview, the run to gold is a very light walk, and then it's a brisk walk, and then it's a light jog, then it's a full jog, then it's a slight run, then it's a run, and then it's a sprint. At this point, I don't think the Fed has really that much to do with it. I think that almost all the good news is in the market right now. And I've been one of the few in our camp, meaning the, pro gold camp, saying I thought we were going to go sideways for some time, which we have. And then we did break above 3,000 and it stayed there for a few days. So we should see some continuance, but it's overbought. And I'm not calling for a pullback here, but it wouldn't surprise me. Yeah, well, there's no knowing, of course, but trend in motion continues until it actually stops, which is basically repeating back to you what you just said. But it's difficult, and the momentum is there. It's pretty far from the 50-day and 200-day moving averages. I think any bad news or further good news that doesn't move the market will be a big clue that we might see a pause. It's good for markets to retrace. I mean, people that buy a stock or a commodity and want to see it go up and it starts to do what they expect, they don't really want to take any down days even, but that's not reality. And it's good to get some people shaken out of a market. I do think that I wouldn't say overdue for a correction. Normally going into the summer, which we're not even close to really. But once we get into the summer months, usually the Europeans don't have as broad a market, and usually see the low in gold historically, seasonality wise, is August. I think that's probably going to hold this year. I don't think so, and I'm very strong on this view. I'm a big believer in the Exter pyramid, which if your viewers don't know, they can look it up. It's EXTER. John Exter worked at the New York Federal Reserve, but he was a gold bug. And he talked about a liquidity squeeze or liquidity crisis. And the pyramid's an upside down pyramid with the least likely investments that are really worth anything at the top of the pyramid, which is upside down. So the base is derivatives, the quadrillion or 2 quadrillion out there, counterparty risks that no one knows what they're worth. And then you come down to the tip of the pyramid, which is gold. I would put silver in there as well. He's gold only. And at the end of as the liquidity squeeze starts in earnest, both the gold and dollar go up at the same time. And that's why I think that the gold, I've said it well over a year ago, Peter, I said the run to gold has started. And people are, oh, what is he talking about, right? He's a gold bug. What does he know? And of course, we've seen the market go from, I don't know what, when I said that, probably 2,600 to over 3,000 now. And what I meant was the big money, the smart money's moving into gold. Central bank buying was huge over the last couple of years. And that continues, as you said. And going back, and I'm not trying to discount what I'm saying, but I'm adding on to what you said. We could just see this thing continue. And why is that? Well, if we get a stock market pullback of enough magnitude that we see a shift in the allocation from equities into commodities, which I expect is taking place or beginning to take place, we could just keep marching forward, get those maybe 1 day or 2 day kind of downdrafts that look somewhat scary because a $50 move in gold isn't that big a percentage anymore. And then people get shaken out or say, oh, I'm going to wait. And the market just keeps going up. The best way to maintain a position in these type of markets, if you're in, follow it up with not a real tight stop, but a stop, and let the market decide for you when to get out. And I do that with my trading position. I'm in for the long haul for my core position. And if you're new and you're worried, you're an equity guy, and most of your net worth is in equities, and now it's starting to roll over. Definitely buy some gold. You don't have to bet the farm. And what do? What I just said, you get in at 3,000. You put a stop at, you look at the chart, or you could just use a percentage. You could use 6, 7%. And then if it moves against you, you lost 6%. But if it keeps going up, just keep moving your stop up. And these markets can be overbought for a long time. And last statement, I'll give it back to you, Peter. And this is an old adage. You're probably old enough to have heard it, but there's no fever like gold fever. So we start getting all those things you outlined that's in gold's favor. What else could happen? It could be a psychology. It could be equities are going down. My pension doesn't look good. I haven't saved enough. Gold's starting to move. Fear of missing out. We get even more momentum. I wouldn't rule that out. I'm not trying to talk out of both sides of my mouth. Technically, it looks like it's due for a correction. But is that 2 days, 2 months, or 2 years? I'm not sure. It does. Yeah, thank you for that. It does. It almost has an exact inverse relationship for a very long time. But when we get to what I call the end game, or people refer to as the end game, this is where, again, we go from that upside down pyramid where people are seeking security. They're no longer interested in how much of a gain can I make in the stock market. They're interested in, I don't want to lose anything. I don't want to lose any more than I've already lost. And when you get that change, that's when people seek the safety. And there's two of the safest things known to the financial markets and the man on the street. That is, that piece of paper has value. I'm not in an investment that can go up and down. I'm not in stocks. I'm not in bonds. I'm not in private equity. I'm not in anything. I'm in the bank. And I'm in the bank in dollars, being number one because it's the reserve currency. So if you're in a third world country or a less advanced economy like Turkey or Argentina or Venezuela or Southeast Asia, you want greenbacks, and that's what they'll buy. That's what they trust. A subset of that, the ultimate money, is gold. So you'll see money flow into the US dollar and gold at the same time for one reason and one reason only, and that's for safety. Yeah, I think it's a rising wedge. It's technically looks bad. A lot of the smart money always refer to Warren Buffett. I mean, Buffett's got a lot of cash on the side. A lot of your billionaire class are not out of the market, but lightened up considerably, noticeably. They've had to file with the SEC so that everyone becomes aware of it. And because of those facts, and the market's long in the tooth, and we've been in a distribution pattern. And I showed for my private work the true price of the stock market, and that's done versus gold, not versus the dollar. And that's one of the books back here called The Invisible Crash. So if you measure the stock market, the S&P 500 specifically in terms of gold, it peaked in the year 2000. And what we have is a huge, massive head and shoulders formation. And right now, the right shoulder, which is where we are in time and space right now, it's a right shoulder that's peaking out and rolling over. And I really believe that's the most accurate way to look at the future, technically. And it shows we're rolling over in the stock market. In terms of gold, we might be going higher in terms of a number, but gold's outperforming as it did last year. And these gold miners, these top tier gold miners, are really got huge margins. They're the value stocks right now. And I just think, as I said earlier, the run to gold has begun, and that the run will continue. As I said on another interview, the run to gold is a very light walk, and then it's a brisk walk, and then it's a light jog, then it's a full jog, then it's a slight run, then it's a run, and then it's a sprint. And that analogy is how it goes. And we're just getting into, I think, the brisk walk right now. Once we start into the jog, that's when I think the public starts to wake up and says, you know what? I've got X amount in my 401k. I don't know what the equivalent in Britain is, but my retirement fund has this, and I'm all equities. And equities have gone down this amount. Gold's up 30% last year. Damn it, I'm going to get some of my retirement in the gold market. And it just takes that new momentum to start pushing it higher. So I'm still bullish. I really think gold's going to be much higher a year from now. But again, I don't like to get people too excited because it's like any market. It does move up and down. No, it is surprising. And that, I think, gives us another clue that maybe the next financial crisis, however you put that in the terminology, because I don't want to scare people. I don't play the fear card. But the reality is we can't live in this debt-based economy much longer. We just can't solve the puzzle. It's a math problem, not a political problem. And because of those facts, I think gold is much stronger than it would be under better conditions economically. And so it's kind of hinting to us that, in my opinion, the worst is yet to come, or the best is yet to come, depending if you're, betting a lot on the gold market or not. But even in a very high priced or high value gold, let's call it value. So gold's buying a lot more men's suits or more oil or more wheat or whatever, so its value is higher, isn't necessarily good for the economy, because what it would indicate, and it has always in the past, is that the macro picture is we're starting to slide in our productive capacity, which means a lower standard of living, not a higher standard of living. Of course, we want the highest standard of living for everybody. I mean, we want enough abundance that everybody on the planet thrives. And that, of course, is not potentially, I think it's there, but staying on track in this train of thought, we're not going to see it because of the misallocations of capital due to the political pressures that so many of the economics are dictated by people that don't know much at all about how to run an economy in a free market, fair, equitable, and balanced situation. There's no perfect thing in life, but the more they meddle, the more they mess it up. James Grant, who's probably one of the best in the business and has been for years, the interest rate observer, said he sees it that there's just as much likelihood that interest rates will go up as go down. And that could take place due to market forces. I mean, everyone thinks the Fed's all powerful, and they are very powerful, but they set the discount window. The market actually dictates the true interest rate. And it's gone along with the political pressure for a long time, and that was the way to bet. I'm not in that camp anymore. I think due to the dollar being strong at the same time that gold is strong, as we already discussed, and the fact that interest rates could go up even though everyone expects them to be going down or should be put down, I think we're in that new allocation model that I keep stressing, and that is that the day of making your mark in the equity markets may be ending. And now where do you go? There's not a lot of places to go. Real estate in the United States isn't doing that well. The commercial real estate's a mess. No one ever talks about it. It's a mess. And the residential isn't all that great, with the exception of a few major cities. And people in the working class can't afford to buy a home, period. And so there's a lot of deflationary pressures going on at the same time. We just keep printing anyway. So we are in stagflation. We've got higher prices with a lowering productive capacity, or lower productive output, I should say. The capacity is probably there, but we're not utilizing it. People don't have money to spend. They're buying groceries and paying rent. Their insurance bills are higher, school costs are more, and all of that. And I'm sure you know the same thing in Great Britain, because I have so many friends there. Correct. You would see maybe gold's getting ahead, they're getting too frothy, it's in the news too much. And the the Fed makes a decision, or the market, that they're going to raise them up. We got a little ahead of ourselves. We didn't need to lower them. No telling what the political class will say, because they'll say almost anything to keep the narrative in their favor. But the reality is that maybe it is starting to overheat, and too much money starting to come back in the U.S. and buy gold, or too many pension funds are starting to roll over and say, you know what, on this next rollover of our long bond, or our 10-year note or whatever, we're going to put some of that cash into real money. We're going to buy gold with it, and that type of thing. I'd really do, that's my main theme with you, Peter, is that the shift, I think, is starting. That brisk walk is starting to break into a jog, and that we're going to see more and more of this. It's not a run. I mean, the panic sprint is when people are calling you and all they want to talk about is gold and what's the price going to be next week. And we're not there yet, but we will, in my view, see it, because all markets act in a similar manner psychologically. There's the stealth phase, the move, then there's the movement for the smart money, then there's the retail phase, then there's the panic phase, and then there's the manic phase. And it just keeps going up, up, up like a parabola. It's an exponential curve in most cases. I'm not trying to be funny. So let's look at the deficit. First of all, Peter's correct. We've had a deficit for the last 3 or 4 years, at least according to Metals Focus and the Silver Institute. But we had a major deficit in the silver price from 1990 to 2005 inclusive. For 15 years, we ate 1.5 billion ounces of above ground silver during that 15-year price of 15-year period. which average at 100 million ounces a year deficit. It wasn't that amount. That's the average. Right now, we're running about 200, 250 per year. But there's still a fair amount of above ground stockpiles that can be eaten into. The point I'm making is this, I haven't said it yet. During that 15-year period, the price was steady Eddie. Now, if that were taking place in oil or wheat or any other market on the futures exchange you can name, that kind of a year over year deficit would have gotten in the newspapers, would have gotten on the financial press, and the price would have gone up because the supply keeps going down year after year after year. In silver, it didn't make a difference. In fact, there's a paper out by, or it's a report, I should say, it's more than a paper, by the Silver Institute you can get for free if you go to, I think it's thesilverinstitute.org or silverinstitute.org. And you could read it, and it basically says what I just stated, that supply doesn't change the price. And it's like, wait a minute. This is against everything we learned in basic economics, but you can make that case. So coming back to what you asked me, some point it will. The price of silver, when the inventory started to reach equilibrium and start to build in the above ground inventory, is about 2006. So the inventory built from 2006, and it's as recently as 3 or 4 years ago, continued to build. The price peaked in April, last day of April 2011. So you had 2005, 6, 7, 8, 9, 10. So you had like 5 or 6 years of inventory build, supplies increasing, and yet the price is going up and up and up and up. So there's something wrong in the silver market. And I'll look in the eye and say, what is it? Yeah, I think you hit it. I think you answered your own question, because if you go back 25 years ago, 35% of the market was industrial. Now it's 60. And so, as I said, if it was wheat or if it was oil or whatever, and you had that deficit, it would change the price. Now that 60% is industrial and continuing to grow, I think it will. So I'm not trying to talk out of both sides of my mouth. I gave you nothing but fact, but things change. And since the industrial side has taken the lion's share of the market now, and maybe jewelry and silverware stay about the same, photography's been a non-issue for a decade, that we have a situation where, yeah, the deficit matters because the industry needs it. And they say, wait a minute, I got to buy and warehouse some because I want to lock in my price for the next year. I don't want that variable in my output on cost of goods sold. I'm going to buy silver now. So I really think you hit it. I think it's going to be different than what I outlined between 1990 and 2005, where it didn't make a difference. I think this time it could, especially when industry wakes up and Apple says, you know what, give us 6 months supply, warehouse it for us. We need it. And then someone sees Apple do that, and Mitsubishi phones up their metals dealer and does the same thing. So I wouldn't rule it out. But it's fascinating to me that this market is really difficult to analyze. It's much different than any other commodity, even gold. I mean, gold, as you say, we know it's money. You can keep increasing the supply, and it keeps going up in price because of economic conditions and devaluation of currencies worldwide. But silver really doesn't have that role anymore. So you got to ask yourself, well, what else is going on? I think you hit it.